All right, what's going on, team? Hope you guys are all having a wonderful end of your week here. So today's video, we're going to be talking about one of the most important aspects of this trading model and of a lot of people's trading models is candlestick setups. Now, if you were to go on Google, you could find probably 100+ different candlestick setups. There's all different kinds of ones, but I'm mainly going to be focused on just 3 or 4 setups, and I guess really it's 6 to 8 since there's a bullish and bearish version of each of them. But the most important thing to keep in mind is that most of these candlestick setups are just showing you technical market structure of the lower time frames. Okay, so if you see, well, I guess it's a little bit hard to describe it before we go into it, but I'll explain this a bit more as we start to pick up the different candlestick setups. Okay, so this is going to be very important for reading charts and for trading in general. I don't think everyone uses them by any means. I think you can still be a profitable trader without them, but they're definitely going to help us a lot with our entries and exits and on helping us to define our risk. So back in the day, I had like a whole slideshow for this, but I just felt like that's kind of a bit unnecessary since we're going to pretty much immediately go to the charts right after looking at these. So I've just kind of drawn them up with some little rectangles here, and hopefully this will be good enough for you guys to understand. So there's a bearish and a bullish alternative to every setup we're going to look at. I can't remember if I drew out the bearish and bullish ones for each, but just keep in mind for any of these setups, there's an exact opposite one when it's happening in the other direction. Okay, so this is going to be the most common one, and in my mind, I feel like most setups are just some kind of variation of this one, and you'll have different traders defining engulfing in different ways, but for me, this is how I define it. Let's start with the bearish one. So you have an existing uptrend here, right? And then out of nowhere, you get a candle that closes in the opposite direction below the previous bullish candle, okay? So again, like I was talking about earlier, let's imagine these are daily candles, okay? This would be 4 days of trading. If you were to zoom in to, say, the 1-hour chart, you would have 24 1-hour candles for each daily candle, right? So you'd have about 100 1-hour candles in this little chart here, right? So what does this look like on the daily? Well, it looks like this, okay? That's the essential price action we're getting. Obviously, it's really a little bit lower here, a little bit higher here, but you get the general idea. But what does this look like maybe on the 1-hour chart? It might look something like this, right? Maybe it double tops up here and then does something like this by the end of this day. So what do we see happening here, guys? We see a pattern of higher lows and higher highs on the 1-hour, which is represented on our daily candles by these green candles that go higher with every single candle. And then here, the daily candles and the 1-hour candles, of course, stop going higher. They top out. Maybe it's a double top. Maybe it's not. Doesn't necessarily have to be. It's just for the example. And then we get a lower high and a lower low behind or below this previous low. So essentially, what do we have? A trend reversal or a trend break, a technical market structure break, whatever you want to call it. This is how we want to think with regards to candle setups, and this is why they can be so useful. We don't necessarily need to see this 1-hour chart and all the different higher lows and higher highs if we have the daily chart looking like this. We can clearly see this is an uptrend, likely higher lows and higher highs, and then here is a bearish engulfing candle that has now closed below this previous daily candle's low, signifying that trend break on a lower time frame, right? So how can we trade this on the daily? Super simple. Your entry is when you close below this bullish candle's low, and your stop loss or your invalidation, where you will cut the trade if you trade above it, is the high of this bullish candle. Okay, now one thing to keep in mind with all these setups is, for example, these are daily candles, right? So during this day, you might trade below this level, but end up forming a wick and closing above it. So typically when I'm talking about candle setups, I'm talking about closing basis candle setups, right? Only taking the trade after this candle has closed and the next one begins to form. Now, you might not get as good of an entry and as good risk reward as if you did it the moment it happened. Like, let's say, this is pretty good risk reward, right? You can enter right below this candle close. But let's say, your daily candle is doing this. It trades down a little bit, then it gets bought up, and then it goes down. But by the daily close, let's say it looks like this, right? Really big. Well, now your entry is actually all the way down here. So it's almost double, or rather half, the risk reward. Because let's say this was a 5% difference to the stop loss. Maybe now it's a 10% difference to the stop loss. But you can have confidence that it's not just going to close all the way up here and form a bullish wick, which would be something you do not want to be selling. This would be a chance to add to your position. Okay? Let's go back to normal. There we go. So it's really up to you if you want to take an entry before the candle close. We call this, oh my gosh, I'm having a brain fart. We call this being contrarian, right? Because you're getting a little bit better risk reward, but you're also kind of gambling that the wick won't form. So I tend to wait until the close is in, whether you're on the 15-minute chart, the 4-hour, or the weekly, doesn't really matter. I prefer closing basis stops. Sometimes it's going to play against you, but it goes the same way. Sometimes you're going to take, you're going to take a sell here, and by the end of the candle, the buyers are going to take it all the way to new highs, and you're going to be stopped out before that candle even closes, and maybe you shouldn't have even taken the trade at all. So it can go both ways, and you don't have to be all in one way or the other. Sometimes you want to play a little bit contrarian. The moment that candle low breaks, you want to start selling. I think that's fine. Sometimes you want to wait for the close just to have certainty that this trend is topping out. I think that's fine too. Okay, so hopefully that makes sense. And then, of course, we have the bullish version of this, where you have an existing downtrend, which, of course, might be represented by something like this on the lower time frames. And then maybe the buyers step in, and you start making higher lows and higher highs again on the lower time frame, which will be represented on the daily by this bullish engulfing candle. And so it's the exact opposite of the bearish engulfing. Your long entry is above this engulfed candle, and your stop loss or your invalidation will go below it. Now, let's say you have some wicks on either end of it. Okay, let's say these don't have any wicks, and typically, especially in crypto, you're going to have wicks on pretty much all your candles, but again, it's just for the base example. A lot of this will be a little bit easier to understand when you see it on the charts. Let's also keep in mind, I'm using red and green because that's probably what most of your guys' charts look like. I use yellow and gray. I don't know why. I've used that for like 6 years now. I can't remember why, but I just prefer it. But regardless, let's say in this bullish engulfing candle, before it closes up here, right? This is where the daily closes. But at some point during this day, it trades as high as this level and as low as this level. In this case, your entry is still the same. It's either a break above this level, above this engulfed candle if you're playing contrarian, or your entry will be the candle close if you're doing a closing basis entry, right? And then as opposed to previously where your stop goes below, is this a bearish one? Yeah, your stop goes below the engulfed candle. This time you would put your stop below the lowest point that this candle goes, okay? Because again, let's think in lower time frame situation, your trend probably looks something like this, And then during this candle, maybe you go a little bit lower one time, the buyers step in really hard and they send it up right before the candle close or something, right? You don't want your invalidation to be below this previous candle. You want it to be below the lowest point it traded before reversing. Okay? So hopefully that makes sense. And then another version of this is what we call a delayed engulfing, basically just signifying that this does not have to happen in a single candle, right? A lot of times that's what you'll see, and it shows a lot of strength, but it doesn't always have to be that way. Sometimes it'll take multiple days to reverse the existing trend, right? And again, lower time frame might look something like this. And then instead of just, V bottoming back to the highs, maybe it takes a little bit longer and a more steady trend reversal like this. Still a trend reversal on the lower time frame, still an engulfing setup, but it's what we call a delayed engulfing because it takes multiple candles to take out this level. But the same as the other engulfings, your entry is a close above the engulfed candle, or if you're playing contrarian, as soon as it trades above that level, you could go ahead and enter, but again, you might get, an unfair trade if it closes back below it. And then your stop either goes below the engulfed candle, or if there's a wick on any of these candles after it, your stop goes below the lowest point in between there, okay? So hopefully that makes sense. Again, this is probably the most common candlestick setup you will see, and in my opinion, most candle setups are some kind of rendition of this. Not all of them, of course, but you'll start to see these all over the place as soon as you know what you're looking for. So super good setup. Something to keep in mind too, for every candle setup, none of these is a 100% strike rate, right? You can have a good candlestick setup like this, and then, the very next day, you just get a giant candle down. The sellers just come in hard and immediately you get stopped out. That's going to happen sometimes, right? Not every time you get an engulfing setup is a guaranteed, I buy here and I make money. It's not always going to work that way, right? Sometimes the market likes to fake you out. The market, I'm not going to say is aware of these kind of setups, but the market might be aware that, or the market makers, whatever you want to refer to, right? That if we paint a little uptrend here, we can fake out a lot of buyers, whereas the big picture trend, you might have a little uptrend here, but the big picture trend might continue making lower highs and lower lows. You know what I mean? So don't expect to buy an engulfing setup and always make money, or sell an engulfing setup and always make money. It's not that simple, but it does give us a slightly better edge when we're looking for good entries, and a slightly better way to define our exits and our invalidations and risk and all that stuff. Okay? So that's the engulfing setups. Again, we're going to look at a bunch of these on the charts once I get through the other few I want to look at, but let's go ahead and look at those real quickly. So next we have topping tail candles and bottoming tail candles. Okay? Essentially just a large wick in either direction, often accompanied by a small bar. In this case, a topping tail is bearish, basically showing that the buyers at some point during this day brought it all the way up here, and then by the time the daily candle closed, the sellers had pushed it all the way back down to this level, often indicating a sign of exhaustion, right? Because the buyers pushed it all the way up, and then as the sellers came in, the buyers had no more strength to push it back higher. Okay? So this candle in and of itself is not necessarily a signal. It can be a sign of exhaustion. Let's say you had, 7 or 8 of these green candles in a row and you haven't taken any profits. You get something like this, it could be a good time to start taking profits. And then once you get the engulfing to accompany it like this, you have an actual sell setup that you can follow. Entry is below this engulfed candle, which is being engulfed by this one, and your stop loss or your invalidation goes above this wick. Okay? And then the exact same on the flip side. you have a downtrend, right? And then at some point in this last daily candle, the sellers push it all the way down and the buyers bring it all the way back up. And then once you get the engulfing, you have a confirmed trend reversal, right? All these lower highs and lower lows have now turned into higher lows and higher highs, accompanied by these, or accompanied by this bullish engulfing plus bottoming tail on the daily chart, right? So pretty straightforward there. Again, by themselves, these topping tails are not necessarily a buy or sell signal. It just might be showing you that the strength of this trend is fading. And sometimes this is going to be a big bait. I see it in Bitcoin all the time. There will be a big wick like this, closes down here. You get a bunch of people selling out of their positions. And then what happens the very next day? We close right above it. You know, happens all the time. So again, these are not 100%. These always work out kind of things. It's just something to look for and can give us a better clarification on our entries and exits. Okay, so that's topping tail and bottoming tail. Basically just a big wick in either direction, opposite of the trend that already exists. Okay. Now this next one is probably my favorite and possibly the best one for adding to your existing positions. This is the BCI, aka the Bullish or Bearish Candle Ignored. And in this case, I did not draw the alternative like the other ones I've drawn, both the bullish and bearish. I think I just forgot to, or maybe it would have taken up too much space. But regardless, the bearish version of this is just everything flipped, right? You know? So what do we have here? We have an existing uptrend. And this is a perfect example of what I was talking about earlier, about the market trying to fake you out. You have an existing uptrend on the lower time frames, something like this, right? And then you have the bears or the sellers come in and they try and break market structure. And maybe it'll close that day below this candle's low, right? And so on its own, this can be a sell setup. But if you get this right after, the bullish, or in this case, the bearish candle ignored, you would stop out of that sale or the short or whatever you want to call it, and you would rebuy this asset because let's see what might have happened here on the lower time frame, right? You close down here, something like this, and then the next day the buyers come back in and they restart this uptrend again. Yeah? So basically invalidating or ignoring this bearish attempt to reverse the existing uptrend. Because you might have a little uptrend here, a new very short downtrend, and then a new uptrend here. On your daily, though, it just looks like an uptrend with a little, you know, a little blip here where the bears come in and try to reverse the trend. So on its own, we have a bearish engulfing candle, and then when we close above it, it becomes a BCI, a bearish candle that was ignored by the overarching trend, right? So how do we trade this? Your entry goes above the bearish candle, right? Either on the candle close, which would be up here, or if you're playing contrarian, as soon as you trade above these highs, you could go ahead and buy. And then your stop goes below the bearish candle, or below the wick of this candle, if there is one. Did I draw that up here? Ah, yes, I did. So same as before, if you have a wick in the candle that does the engulfing, then instead of your stop loss going below the engulfed candle, it'll just go below the low of this candle. Okay, so buy here, stop loss here. And this is probably one of my favorite setups in trading because, again, it's not 100% win rate, but 9 times out of 10, this candle that ignores this one almost always has followed through with this candle. So one of the typical rules for this is you don't ever take profits on this candle because 9 times out of 10, if you close this BCI, you're going to get follow through on the next candle. 9 times out of 10. And I won't say 9 times out of 10 for this, but more often than not, this BCI becomes the middle of a bigger move. So if you have 4 candles up and then a BCI, which is confirmed by this engulfing, more often than not, you get 4 candles up right after it. And again, that's not always going to be the case. Sometimes you'll get more. Sometimes you might only get this one candle after the BCI, and then the trend just breaks down. But, I don't know, 7 out of 10 times maybe, I would say that the BCI ends up being the middle of a bigger move. And then, you might end up painting another BCI after that, right? At which case, you can add to your position. A cool way to look at that could be, maybe this was your original entry, right? You bought this bullish engulfing candle, stop below the low. And then let's say these are the candles that follow that bullish engulfing, right? And then you get this attempted trend reversal. Maybe you take some profits on this, right? Because you're up a fair bit since your entry on the bullish engulfing. And then immediately, the next candle closes back above the highs. You can add back what you took off and maybe even some more. And then also, you can raise your stop loss from the initial trade from this bullish engulfing here to the low of this bearish engulfing, right? Or BCI. And then likewise, if you get another one here, then whether you added on this or not, if you're in from the original entry on that bullish engulfing below, you raise your stop once again. Okay, so now your stop loss is well above your original bullish engulfing entry, which again is this. I'm just, I didn't draw it in because I didn't know I was going to do that example, but you get the idea, right? You bought a bullish engulfing, you made some money, maybe you took a little bit of profits here, or after the bearish engulfing, and then you get the BCI, maybe you add some more on, you raise your stops to below this level, you get another one, maybe you add some more, you raise your stops once again to this level, and so you're keeping decent risk, right? You're keeping the small risk on the table, and you're compounding your position, right? You're taking some profits, you're adding it back, you're taking some more, you're adding back, so on and so forth. Okay? This is my favorite setup. You're going to see it everywhere, especially in crypto. You will get these just monstrous trends with BCIs all the way up, and they can be great opportunities to add to your existing positions. Okay, so definitely keep that in mind. And I think that's about it. Oh, I have one more up here. Oh, no, this is just the example of the wick on the BCI. But I do have one more, which is, again, just a kind of another form of the BCI, which often leads to trend continuation, which is a topping tail takeout. Again, there's an exact reversal of this in a downtrend called the bottoming tail takeout, which would look something like closing below this candle. Let's say instead of this, we had, something like this. That would be a bottoming tail takeout, okay? So what exactly is this? It's the same as the BCI that we just saw. You essentially have a strong uptrend here. The buyers push it up, and the sellers bring it all the way down by the daily close, essentially trying to reverse this existing trend. Again, this is kind of a weak reversal, but let's say you did something like this. That would be a very strong one. Either way, if you get a candle like this after that closes above the wick, that's called a topping tail takeout and is a very strong buy setup or a chance to add to your position. And then just like the BCI before, your entry is above the high or the wick, and your stop goes below the low or below the wick if there is a wick on this reversal candle. Okay, so I know this can be a little bit confusing maybe on your first time watching it, especially if you haven't really gotten yourself familiar with charts much, but I promise the more time you look at charts, the more sense this is going to make. And if you guys ever have any questions about it, you're always welcome to hit me up in the Discord, and I'll try to help you as best I can. So let's go to the charts now, which are way down here, and see if we can find some examples of this. All right. So let's do the weekly chart. And I'm going to just hold this here and see if you guys can see any of these. Anything that really sticks out. Obviously, I'm not waiting for you to go, hey, me this one, but just take a second. Do you see some clearly obvious BCIs or bullish engulfing setups? Let's also get rid of the moving averages. We don't really need those for introduction to candlestick setups, but I see one right in the middle of the screen here. Right? So again, keeping market structure in mind, what might this look like on the lower time frame? Well, you have a move down, a move higher, a move lower, a move higher, a move lower. Essentially, a downtrend that probably looks something like this on lower time frames, right? And then what do we have here? A super clean bullish engulfing, right? Now remember, when there's a wick on the engulfing candle, we move our stop loss to the low of that candle. And here's another really important thing to keep in mind, guys. This is a valid stop loss, but when the local low of this entire area is really close to our candle setup, more often than not, I'm going to opt to put my stop loss below the entire low there. Because essentially, this candle is trying to make a higher low, right, in front of this low. So my setup is not necessarily invalidated unless we actually trade below the low of this level. Now, you don't have to do this, and obviously the higher up this wick is, the worse the risk reward is going to be to do this, but you're probably going to get stopped out less, even with a little bit worse risk reward. So just keep that in mind. So how would you play this, right? Also notice how we have not had one of these during this entire move down from $58,000 Bitcoin to 30,000, right? The high of this bearish candle never gets closed above. The high of this one never gets closed above. The high of this bearish candle never gets closed above. This one tries to, and this wick would be a good example of why playing contrarian can sometimes hurt you, because at some point during this daily candle, it probably looked like this, where it looked like it might close above the highs of this previous bearish candle, but by the end of the day, the sellers pushed it back down. Okay? And once again, this candle high does not get traded above until this bearish candle right here finally gets engulfed by this one. And that is a very simple buy setup. Easy peasy. And then I can't remember if we've talked our take profit rules yet, but I can briefly go over them here real quick. We often want to take profits 2 to 3 candles after our entry. This is known as the initial surge. And so, again, you bought this candle, you get 1, 2, 3 candles in your favor. Either of these is a good time to take your initial wave of profits. The reason for this is sometimes you're going to get a good entry and the trend is going to just be a really big winner. But sometimes you might only get 2 or 3 candles before it just rolls over. Because like I said, not every candle setup is going to be a big winner. Sometimes it's just going to flop. So if on this entry you're risking, $1,000 to this stop loss and you take $250 worth of profit here, well, now at this point, if your stop loss gets hit, if it just gets crushed, you're not going to take a full loss, right? So again, just example numbers here, but that might be how you trade that. And then here's a great example of when a candle setup is not going to work out, right? We have a BCI right here. An attempt to stop or reverse this trend, which immediately gets taken out by this candle here, right? So that's a chance to add to your position and raise your stop loss to below this BCI right here, which again, the very next day gets stopped out. So you'll take a small loss on this BCI here, and you will close your initial entry here as you raised your stop loss from the low up to this BCIs low at this point. Okay, and so that's a complete trade right there. Probably a big win from your entry down here, and then a small loss here, and that's the end of that. Right, and then here's another potential entry right here with this bullish engulfing. You see that? Right, the high of this candle gets closed above by this one, and your stop loss is going to go right below the low. Yeah? And then once again, following take profit rules, you get 1, 2, 3 candles in your favor. That's not a bad time to take your first wave of profits. And then not too many candles later, we get a huge bearish engulfing following 2 pretty minor topping tail setups. But we have to keep in mind, with respect to our overall trend, look at where those topping tails occur, right? We wick into a previous high from months back. The buyers push it up during this candle, and then the sellers push it back down, showing that the buyers did not have enough strength to push through this level. Unlike, say, current day, where the buyers are pushing through this level already, right? This is a sign of weakness. This is a sign of strength. Yeah? And so let's say again that you entered on this engulfing setup and you took some profits, 2 to 3 candles in your favor. Now you get a bearish engulfing, maybe another good time to take some profits. Yeah? And then it's up to you if you want to close on the bullish engulfing or not. If not, then you're probably going to end up adding on the next bullish engulfing, which gives you a new stop loss, which is essentially the trend has bottomed here, made a higher low, tried to make a higher low here, and then it just ended up getting crushed and we had a new downtrend. Again, maybe I shouldn't have picked the end of a bull market for long setups, but it gives you a good idea of what we're talking about here. And also that just because you have a bullish engulfing does not mean it's always going to go up after, right? So yeah, those are some typical bullish engulfing setups. Again, you have the exact same thing in the opposite direction. Here's an example of a delayed bearish engulfing right here, right? Where you have an existing downtrend like this, and then price tries to reverse that very closely and immediately just gets slammed back down. Okay, so how do you go about trading this, right? As soon as you close below this bullish candle, which happens on this candle, that is your entry. And then your stop goes not above this candle, but above the wick of the highest point of this move. Okay, so that's your sell setup. And then just like on the opposite direction, 1, 2, 3 candles in your favor. Not a bad time to take your first wave of profits. What do we have here? A little BCI, right? Keep in mind, if we were to zoom in on lower time frame, we'd have a little downtrend like this. And here, the buyers try and reverse that trend. They try with all they've got. But by the end of the daily candle, the sellers have brought it back down. And then the next day, the sellers close a bearish engulfing back below that. That's a chance to add to your existing short position that you started back here, right? So then you sell more here, and now you can raise your stop from your initial trade, which was below or above this high, to above this high. And then you get pretty much immediate follow through, which again is pretty common for BCIs. When you get a drastic candle like this, quite often it's a good idea to take profits immediately. But if not, then you pretty much just wait for the next major bullish engulfing, right? Which looks like it happens right here, right? See that? This candle gets engulfed by this candle. So that might be a good time to close out this entry here, as well as take profits on this BCI entry here. And then you just wait for the next setup. Keeping in mind that depending on what trend you're in will determine which direction you want to be looking for setups more in. Like during this period of time, we're trying to look for more long entries, right? And then during this period of time, since we're in a downtrend, we're looking more for short entries, right? So right after we close that trade on this candlestick setup, not even, 4 days later, we get another bearish engulfing sell setup, and then pretty much another right after it, another one here, and only after this candle do we really start to reverse that trend, and then we're looking for long setups again. There's a bullish engulfing there, another bullish engulfing there, another one here, followed by an immediate bearish engulfing, which could be a decent time to take some profits. Another bullish engulfing there, potential entry. Another one there. Oh, and this is a good time to point out how closing basis setups can really sometimes save your butt versus hard stops. So let's just look at this setup here, right? This is a bullish engulfing in an existing uptrend. So we're already looking for longs. We want to be a buyer in a strong uptrend, right? Where would we put our stop loss here, right? This is the candle that's being engulfed, right? This little doji or whatever you want to call it here. Do we put our stop below that? No, we put it below the low of this candle. Also notice how the local low from 2 candles back is almost at the exact same level. So let's play safe. It'll cost us almost nothing in position size. And let's put our stop below there. So we can do this one of 2 ways with the closing basis stop, meaning look at our price over here. This level is 25,760 or something like that, right? So we say if a daily candle closes below that level, we'll cut the trade. Or you can just immediately put a sell in the book, a limit sell or a limit stop, and say if the market trades at below this price, cut my position. Okay? And so what's going to happen is you're going to wick into it. So if you have a hard stop in the books, you're going to be out here, right? Which is not the end of the world, right? You managed your risk and you kept the loss small. It's not that big of a deal. But if you're doing a closing basis stop, there's no reason to exit the trade yet, as we never close below this level. So when this big candle forms, you are still in this trade, and this could even be a chance to add more. And now that we have wicked into these levels, we have essentially extended our range of invalidation. Okay? And if that has made your risk too high, then you can simply take some profits and adjust so that your risk back to this level is managed. Yeah? And then moving forward, let's see what else we get here. Obviously, I already know because I remember this, but once again, here's our risk. You get another bullish setup right here. Another chance to add. As this candle, hard to see it, but it does just barely closes above this one. That's a chance to add to your existing longs over here. And it's also very close to those entries. In fact, even below this one. So you can bring down your average cost. And once again, do we put our stop loss below the engulfed candle low here? No, we put it below the engulfing candles low. And since that is also very close to our local low here, we might as well put our stop loss below that level. And again, you don't have to do that, but I find you're going to get stopped out a lot less when you do this. And then what do we have? A BCI here. That's another chance to add, right? You buy the top of this candle, and your stop loss can either go below, not the tool I was looking for, below the setup on this addition, right? Here's your entry above this candle's high. You can put your stop below there. Or again, when you get any kind of setup close to a previous local low, I quite often just opt to use this low. But if you want to add a little bit more size, keep your risk a little bit tighter, it's still valid to put your stop loss here. Okay, and then just a couple candles later, we get another bullish engulfing as well as a BCI. That's another chance to add to our existing position. And then we get the follow through after months of accumulation. Right? Then we get 2 to 3 candles in your favor. Good chance to take your first wave of profits. And again, I won't go too much into profit techniques here. We're going to cover that in its own video. But the next rule is 5 to 8 candles in your favor. You take your next wave of profits. And then after that, one of our most powerful tools will be a trailing stop, and we'll go into that later. What do we have here? A big topping tail could be a good sign to take some profits. Now, are we going to exit our previous position, though? Let's think about this, right? Where's our most recent setup? Our most recent setup looks to be this one here, right? We don't have a topping tail. We have a topping tail, but we don't have an actual setup because we don't close below the low of this candle, right? If we came in with this candle and we had a nasty bearish engulfing like this that closed below this candle, that might be a sell setup. But what do we end up doing? We wick into it on 2 separate days, meaning the sellers really tried to start a new downtrend, but the buyer said, nah, I'm going to scoop that. And they bought it up by the end of the daily close, which is a bottoming tail setup. If we close back above this previous candle's high, that will be another chance to add, which we do on this day. And then you get the follow through and the next big trend after that, leading us to where we are today. Oh, and what do you know? Another BCI, a chance to add. So that's just a few examples of candlestick setup, guys, and we're going to be focusing on this pretty much the rest of the course. It'll be a part of it until the very end. So if you're looking for more examples, you're going to get them, and we're going to incorporate some of our other techniques like trading with the cycles, using momentum to our advantage, profit-taking rules, risk management, how to calculate how much you want to risk per trade, all that good stuff. We'll be focusing on that in the coming videos. So I know this was a pretty long one. We're about 40 minutes in here. Definitely going to be one of the longest videos of the course, but I really want you guys to spend time going through charts, trying to identify candle setups. You are more than welcome to go through a chart, write in some of the candle setups, how you might trade them, and send them my way. I'd be happy to analyze it and see if I think you handled it well. Okay, so those are the candlestick setups, guys. In the next video, we're going to kind of bring it all together a little bit and see how we can use these candle setups with our other indicators, combine them into one actionable setup. Okay, so that'll be next time. Don't feel like you have to rush right into that one, though. Definitely spend some time looking at the charts, trying to identify candle setups. You really want to be able to go through charts pretty quickly and immediately see, well, you're going to get misprints like that sometimes. Immediately be able to see candle setups. Like there's a bearish engulfing, bearish engulfing, bearish engulfing, bullish engulfing, bearish engulfing, bullish engulfing, bullish engulfing, BCI, 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 BCI. You want to be able to identify this stuff basically immediately. Okay, so spend some time on that, and I will see you in the next video. Thanks so much, guys. Peace.